Game over. The era of fiat currency, the paper money we've trusted for decades, is coming to an end. What once seemed like an unshakable foundation of the global economy is now cracking under the weight of unprecedented debt, relentless money printing, and eroding trust. For years, central banks have flooded the world with cheap money, propping up failing systems and inflating asset bubbles. But the consequences of these policies are now impossible to ignore. Why is this happening now? Because the global financial system has reached a breaking point. Inflation is soaring, currencies are losing value at record speeds, and governments are running out of options to keep the game going. The trust that underpins fiat money, the belief that it holds value because the government says so, is evaporating. When that trust disappears, so does the currency's power. The stakes couldn't be higher. This collapse threatens to wipe out savings, devastate purchasing power, and trigger economic chaos worldwide. But amid the turmoil, opportunities arise for those who understand the shift and act decisively. In this video, we'll uncover the forces driving fiat currency's demise, explore what it means for you, and reveal how to protect your wealth before it's too late. Fiat currency is the type of money we use every day: dollars, euros, yen, and most other national currencies. Unlike commodity money, which is backed by a physical asset like gold or silver, fiat money has no intrinsic value. Its worth comes entirely from the trust and confidence that people place in the issuing government and its central bank. At its core, fiat currency is a legal tender declared by governments, meaning it must be accepted as payment for debts and taxes within that country. This legal status gives fiat money its power, but it also means its value is not guaranteed by any physical commodity. Instead, its value is maintained through government policies, monetary control, and most importantly, public trust. How does fiat currency work? Central banks control the money supply by issuing currency and regulating interest rates. They use tools like open market operations, reserve requirements, and quantitative easing to influence economic activity. When the economy slows, central banks can inject liquidity by printing more money or lowering interest rates to encourage borrowing and spending. Conversely, they can tighten the money supply to control inflation. However, this system relies heavily on trust. People must believe that the currency will hold its value over time and that the government will manage the economy responsibly. If confidence falters due to excessive money printing, political instability, or economic mismanagement, the currency's value can plummet, leading to inflation or even hyperinflation. Unlike gold or other tangible assets, fiat money can be created at will, which is both a strength and a weakness. It allows governments to respond flexibly to economic crises, but also opens the door to abuse and devaluation. When governments print too much money without corresponding economic growth, the currency loses purchasing power and prices rise. In essence, fiat currency is a social contract, a shared belief in its value backed by government authority. When that contract breaks down, the currency collapses. Understanding this fragile foundation is key to grasping why the end of fiat currency as we know it is not just possible, but increasingly likely. The decline of fiat currency is not a sudden event, but the result of several interrelated factors that have been building over decades. Understanding these causes is essential to grasp why the system is unraveling and what it means for the future of money. Excessive money printing. One of the most significant drivers of fiat currency decline is excessive money printing by central banks. In response to economic crises, such as the 2008 financial meltdown and the COVID-19 pandemic, central banks worldwide unleashed unprecedented rounds of quantitative easing, QE. This process involves creating new money electronically to buy government bonds and other financial assets, injecting liquidity into the economy. While QE can stabilize markets in the short term, it also increases the money supply dramatically. When more money chases the same amount of goods and services, prices rise. This devalues the currency, reducing its purchasing power. The problem worsens when money printing becomes a remainant policy rather than a temporary fix, leading to chronic inflation and eroding trust in the currency's value. Debt accumulation. Closely tied to money printing is the massive accumulation of debt by governments, corporations, and consumers. Governments have borrowed trillions to fund stimulus programs, social services, and military spending. This debt is often financed by issuing bonds purchased by central banks or investors, effectively turning debt into money. As debt levels soar, servicing that debt requires even more borrowing or money creation, creating a vicious cycle. High debt burdens limit economic growth and increase the risk of default or restructuring. When investors begin to doubt a government's ability to repay, confidence in its currency wanes, accelerating the currency's decline. Inflation and purchasing power. Erosion. Inflation is the natural consequence of excessive money supply growth and debt accumulation. It represents the general rise in prices across the economy, meaning each unit of currency buys less than before. Moderate inflation is normal, but when it accelerates uncontrollably, it becomes a crisis. In many countries, inflation rates have surged to multi-decade highs, driven by supply chain disruptions, energy price shocks, and expansive monetary policies. This rapid inflation erodes savings, wages, and fixed incomes, disproportionately hurting ordinary people. As inflation spirals, the public loses faith in the currency's ability to store value, prompting a rush into tangible assets like gold, real estate, or foreign currencies. Loss of confidence and trust. Perhaps the most critical factor in fiat currency collapse is the loss of confidence. Fiat money's value depends entirely on collective trust. Trust that the government will maintain economic stability, honor debts, and control inflation. When this trust breaks down, the currency's value can plummet rapidly. Loss of confidence can be triggered by political instability, corruption, poor fiscal management, or external shocks like wars and sanctions. It can also be self-reinforcing. As people lose faith, they spend or convert their money quickly, accelerating inflation and further undermining trust. Historical examples abound, from the Weimar Republic's hyperinflation in the 1920s to Zimbabwe's collapse in the 2000s, where loss of confidence led to currency abandonment and economic chaos. Today, similar warning signs are emerging globally, with central banks struggling to contain inflation and governments facing mounting debt crises. The perfect storm. These factors, excessive money printing, debt accumulation, inflation, and loss of confidence, do not act in isolation. Together, they create a perfect storm that threatens the very foundation of fiat currency systems. Central banks' attempts to manage crises with more money printing only deepen debt and inflation problems, while public trust erodes under the weight of economic uncertainty. This downward spiral makes it increasingly difficult for governments to stabilize their currencies without drastic measures, such as currency redenomination, capital controls, or default. For investors and citizens alike, recognizing these dynamics is crucial to preparing for a future where fiat money may no longer serve as a reliable store of value. Central banks are the architects of modern monetary policy, wielding immense power to influence economies and financial markets. However, in recent decades, their policies, especially quantitative easing, QE, and negative interest rates, have unintentionally accelerated the decline of fiat currencies worldwide. While these tools were designed to stabilize economies during crises, their prolonged use has undermined the very foundations of fiat money, fueling inflation, distorting markets, and eroding public trust. Quantitative easing, flooding the system with money. Quantitative easing is a policy where central banks create new money electronically to purchase government bonds and other financial assets. This injection of liquidity aims to lower interest rates, encourage lending, and stimulate economic growth during downturns. QE was first widely used after the 2008 financial crisis, and then again during the COVID-19 pandemic, with central banks expanding their balance sheets to unprecedented levels. While QE helped prevent immediate economic collapse, it also dramatically increased the money supply. More money chasing the same goods and services inevitably leads to inflationary pressures. Unlike traditional monetary policy tools, QE injects liquidity directly into financial markets rather than through the banking system, inflating asset prices such as stocks, real estate, and bonds. This creates wealth disparities and asset bubbles which can burst with devastating consequences. Moreover, QE blurs the line between fiscal and monetary policy. By buying government debt, central banks effectively finance government spending, reducing the incentive for fiscal discipline. This dynamic encourages governments to accumulate more debt, knowing central banks will absorb much of it. The result is a debt-fueled economy where money printing becomes a permanent feature rather than a temporary crisis response. Negative interest rates, penalizing savings and distorting markets. Negative interest rate policy, NIRP, is another unconventional tool used by central banks to stimulate economies when traditional rate cuts reach their limits. Under NIRP, banks are charged for holding excess reserves at the central bank, incentivizing them to lend more. The goal is to spur borrowing, investment, and consumption. However, negative rates have several unintended consequences that accelerate fiat currency decline. First, they punish savers, reducing returns on deposits and retirement accounts. This erodes public confidence in the financial system and the currency itself, as people see their savings lose value in real terms. Second, negative rates distort financial markets by encouraging excessive risk-taking. Investors, desperate for yield, pour money into riskier assets, inflating bubbles and increasing systemic risk. This behavior undermines market stability and can lead to sudden crashes, shaking faith in fiat currencies and central bank policies. Third, negative rates weaken the currency by making it less attractive to foreign investors. While a weaker currency can boost exports, it also raises the cost of imports and fuels inflation. Persistent currency depreciation further erodes purchasing power and public trust. The feedback loop: inflation, debt, and loss of confidence. QE and negative interest rates create a feedback loop that accelerates fiat currency decline. Central banks print money to finance government debt and stimulate growth, which leads to inflation. Inflation erodes real incomes and savings, prompting demands for higher wages and prices, which in turn fuels more inflation. To combat slowing growth or market instability, central banks often respond with more QE or rate cuts, perpetuating the cycle. This loop undermines the currency's value and the public's faith in its stability. Erosion of central bank credibility. Perhaps the most damaging effect of these policies is the erosion of central bank credibility. Central banks are supposed to be guardians of monetary stability, controlling inflation and maintaining trust in the currency. However, their unprecedented interventions have raised doubts about their independence and effectiveness. When markets perceive that central banks are simply monetizing debt and suppressing interest rates to prop up governments and financial institutions, confidence wanes. This loss of trust can trigger capital flight, currency crises, and a rush into alternative assets like gold and cryptocurrencies. Historical parallels and modern risks. History offers cautionary tales. The Weimar Republic in the 1920s and Zimbabwe in the 2000s both experienced hyperinflation, fueled by excessive money printing and loss of confidence in fiat currency. While today's central banks operate in a more complex global system, the fundamental risks remain. The prolonged use of QE and negative rates has pushed fiat currencies closer to these tipping points. As inflation rises and debt burdens grow, central banks face a dilemma: tighten policy and risk economic contraction, or continue easing and accelerate currency decline. The collapse of fiat currency systems triggers far-reaching consequences that ripple through economies, societies, and geopolitics. As trust in paper money erodes, the impacts become visible in soaring inflation, intensified currency wars, diminished purchasing power, and growing social unrest. Inflation and erosion of purchasing power. One of the most immediate and painful effects of fiat currency decline is inflation, the rapid increase in prices for everyday goods and services. As governments print more money to cover debts and deficits, the value of the currency falls, meaning consumers need more money to buy the same items. This erosion of purchasing power hits the most vulnerable hardest, especially those on fixed incomes or with limited savings. Inflation also disrupts economic planning. Businesses face higher input costs and uncertainty, which can slow investment and hiring. Consumers, squeezed by rising prices, reduce spending, potentially triggering economic slowdowns or recessions. Currency wars and geopolitical tensions. As fiat currencies weaken, countries often engage in currency wars, deliberately devaluing their money to boost exports and gain competitive advantages. While this may provide short-term relief, it fuels global instability. Competitive devaluations can spiral, undermining international trade and cooperation. Currency wars also exacerbate geopolitical tensions. Nations may impose capital controls, tariffs, or sanctions to protect their economies, fracturing global alliances. The weakening of dominant reserve currencies, like the US dollar, can shift power balances, encouraging rival blocs and increasing the risk of conflict. Social unrest and political instability. The economic hardships caused by fiat collapse often lead to social unrest. Inflation and loss of purchasing power breed frustration and anger among citizens, especially when wages fail to keep pace with rising costs. History shows that hyperinflation and economic crises frequently spark protests, strikes, and even revolutions. Political instability can follow, as governments struggle to maintain order and legitimacy. Populist movements may gain traction, promising radical solutions, but often deepening divisions. In extreme cases, economic collapse can lead to state failure or civil conflict. The broader picture. Together, these economic, social, and geopolitical impacts create a volatile environment where fiat currency collapse is both a symptom and a cause of deeper systemic breakdowns. For investors and citizens alike, understanding these consequences underscores the urgency of preparing for a world where traditional money loses its power and new forms of value and exchange emerge. As fiat currencies lose value and trust erodes, investors worldwide are seeking refuge in alternative assets that can preserve wealth and hedge against economic uncertainty. Among the most prominent of these are gold, cryptocurrencies, and other tangible assets, each offering unique advantages in a world where traditional money is faltering. Gold, the timeless safe haven. Gold has been a trusted store of value for thousands of years, prized for its scarcity, durability, and universal acceptance. During periods of fiat currency decline, gold's appeal intensifies as it provides a hedge against inflation and currency devaluation. Unlike paper money, gold cannot be printed or diluted, making it a reliable asset when central banks flood markets with liquidity. Investors buy physical gold, bars, coins, and jewelry, as well as gold-backed financial instruments like ETFs and mining stocks. Gold's role as a crisis hedge is reinforced by its historical performance during economic turmoil, making it a cornerstone of wealth preservation strategies. Cryptocurrencies, the digital frontier. In recent years, cryptocurrencies like Bitcoin have emerged as a new class of alternative assets. Designed to be decentralized and limited in supply, cryptocurrencies offer a digital form of hard money that is independent of government control. For many investors, cryptocurrencies represent a modern hedge against fiat currency collapse and capital controls. While cryptocurrencies are more volatile and less established than gold, their growing adoption and technological innovation have attracted significant interest. They provide liquidity, ease of transfer, and potential for high returns, appealing especially to younger, tech-savvy investors. Tangible assets, real estate, commodities, and collectibles. Beyond gold and crypto, investors are also turning to other tangible assets, such as real estate, agricultural land, and commodities like silver, platinum, and energy resources. These assets have intrinsic value and often generate income or utility, making them attractive during inflationary periods. Collectibles, art, rare coins, vintage cars, also serve as alternative stores of value, though they carry higher risks and require specialized knowledge. Diversification and protection. The shift toward these alternatives reflects a broader strategy of diversification and protection. By spreading wealth across multiple asset classes that are less correlated with fiat currencies and traditional financial markets, investors aim to reduce risk and safeguard purchasing power. As fiat currencies face mounting pressures, the demand for gold, cryptocurrencies, and tangible assets is expected to grow, reshaping investment landscapes and challenging the dominance of paper money. In the face of a collapsing fiat currency system, protecting your wealth requires a strategic approach focused on diversification, timing, and risk management. Here's how you can navigate this turbulent environment effectively. 1. Diversify across asset classes. Don't put all your eggs in one basket. Spread your investments across a mix of assets that perform well during currency devaluation and economic uncertainty. This includes physical gold and silver, cryptocurrencies like Bitcoin, real estate, and inflation-protected securities. Diversification reduces risk and cushions your portfolio against shocks in any single market. 2. Prioritize tangible and hard assets. Focus on assets with intrinsic value that cannot be printed or devalued by governments. Physical precious metals, real estate, and commodities provide a hedge against inflation and currency collapse. Ensure you hold a portion of your portfolio in physical form, such as bullion or coins, to avoid counterparty risks associated with financial instruments. 3. Timing and dollar cost. Averaging market volatility will increase as fiat currencies weaken. Instead of trying to time the market perfectly, use dollar cost averaging, investing a fixed amount regularly to build your position gradually. This approach reduces the risk of buying at a peak and smooths out price fluctuations. 4. Manage risk with position sizing and liquidity. Allocate a sensible percentage of your portfolio to alternative assets based on your risk tolerance, typically between 10% and 30%. Maintain liquidity by keeping some cash or cash equivalents to seize opportunities or cover emergencies. Avoid overexposure to highly volatile assets like cryptocurrencies without proper risk controls. 5. Stay informed and flexible. The economic landscape is evolving rapidly. Stay updated on monetary policies, inflation trends, and geopolitical developments. Be ready to adjust your strategy as conditions change, and consider consulting financial advisors experienced in crisis investing. By diversifying wisely, investing steadily, and managing risk prudently, you can safeguard your wealth and position yourself to benefit as the fiat system transforms. The collapse of fiat currency is no longer a distant threat. It's happening now, driven by excessive money printing, soaring debt, and eroding trust. Central banks' policies have accelerated this decline, fueling inflation, currency wars, and social unrest worldwide. In this uncertain environment, diversifying into gold, cryptocurrencies, and tangible assets is essential to protect your wealth. Timing and risk management are critical. Act now before it's too late. Stay informed, stay prepared, and safeguard your financial future. If you found this valuable, subscribe for more insights, diversify your portfolio wisely, and keep watching as this historic shift unfolds.